Here is something most personal finance advice gets wrong. It treats debt and investing as two separate conversations. Pay off your debt first, they say. Or start investing as early as possible. But neither of those answers is complete. The real answer is about sequence. And getting the sequence right can save you thousands of pounds. Let's start with a number that might surprise you. The average UK credit card rate right now is around 24%. A $1,900 balance at that rate costs you roughly €468 a year in interest, just for doing nothing. That is not a savings problem. That is a fire you need to put out before you do anything else. So here is the order, and why it works. First, before you attack any debt, build a small buffer, around $500 to $1,000 in a savings account. Not because saving is the priority right now, but because without a cushion, the first unexpected bill sends you straight back to the credit card. You solve debt with debt. The buffer breaks that cycle. Second, list every debt you have: the balance, the interest rate, the minimum payment. Be honest, then separate them into two piles. High-interest debt, anything above roughly 10% APR, gets attacked aggressively. Low-cost debt, a mortgage, a 0% deal, a student loan, can be managed normally while you move on to investing later. For the high-interest pile, you have two strategies. The avalanche method targets the highest interest rate first and saves the most money overall, sometimes $500 to $500 more than the alternative. The snowball method pays off the smallest balance first, which feels less optimal on paper, but has a higher completion rate in practice because early wins keep people going. Either works. What matters is that you pick one and stick to it. Here is a concrete example. A $5,000 debt at 19.9% APR, paying $200 a month, is cleared in about 3 years with roughly $1,200 in interest. Pay only the minimum, and you're looking at over 9 years and nearly $3,700 in interest. That is the cost of inaction, written in plain numbers. One optional tool worth knowing about: a 0% balance transfer card. Moving existing debt to one of these can give you 18 to 29 months interest-free, usually for a 2 to 3% transfer fee. On a $5,000 balance, that fee might cost $150. But it could save you over $1,000 in interest if you use the time to clear the debt properly. It is not magic, but it can accelerate things significantly. Now, and this is the part people miss, once the high-interest debt is gone, the maths flips. Stock markets have historically returned around 7 to 10% per year over long periods of 20 years or more. You were paying 24% to borrow money. Now you have the potential to earn from it instead. That is the tipping point. Every pound that was going to debt repayment now goes into a stocks and shares ISA, where returns are sheltered from capital gains tax and income tax entirely, up to $20,000 a year. Inside that ISA, a simple global index fund, one that tracks a broad market index, gives you instant diversification at low cost without needing to pick stocks or time the market. The sequence matters. Debt first, buffer early, invest once the expensive borrowing is cleared. That is not a theory. That is just arithmetic.